Welcome to the Best Interest Podcast, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 96 of the Best Interest Podcast. My name is Jesse Kramer. Today we've got a fun one for you. It's going to be a little end of year in review of the podcast. Shouldn't take us too long, just a few minutes. But then I'm going to dive into an evergreen topic, an important topic, one that a lot of people ask questions about. And really, this is going to be an episode that I hope that people can point back to and say, there's a really comprehensive answer to the question of, well, is now the right time to invest in the stock market? Whether it's because the stock market is doing really well, or on the opposite side of the coins, there will be periods when the market will go through a bear market, we'll have a recession, we'll have some sort of pullback, and people will be fearful of investing during those times. Is now the right time to invest in the stock market? So I hope to tackle that today and to explain a few interesting concepts that are all interwoven into that question so that we can walk out of here not only knowing the right answer of how and when to invest, but also why that's the right answer and how all these different puzzle pieces fit together. Before we get to that, we do have a customary review of the week today. This one is from LJB. LJB gave us a 5-star review on Apple Podcasts and wrote in and said, "Great listen. This is a podcast I'm glad I finally stumbled onto. Jesse does a great job of taking the everyday, mundane, and common topics and making them applicable to his listeners. This is an easy add to the queue every time a new episode pops into my feed." Well, LJB, thank you for the kind words. Feel free to reach out to me. Send me an email to jesse@bestinterest.blog. We'll get you hooked up with a super soft t-shirt. Okay, let's get into a little bit of a year in review. Like I said, short and sweet. We had 51 new blog posts. As of this recording, it's December 12th right now when I'm talking to you. 46 weekly newsletters. Since the baby was born, sometimes I missed a week or I combined 2 weeks into one newsletter, but still 46 weekly newsletters. You can subscribe to that on the blog homepage at bestinterest.blog. About 2,500 new subscribers to that newsletter. When this episode comes out, we'll have had 26 new podcast episodes every other week. And total podcast downloads, fantastic. 41,000 downloads as of this recording. We only had 12,000 downloads last year, so that's more than a 3x growth with dozens of 5-star reviews, very, very kind reviews, lots of smart and exciting guests with all manner of financial expertise. Dozens of your questions answered on our AMA episodes. So thank you. Engaging with you listeners, that's probably the best part about this project. So please keep the emails coming, keep the questions coming. They're great. It gives me something fun and interesting to talk about. Sometimes something that's fun and interesting to learn, something new for me that I get to dive into and learn about. To preempt a common question that I get, no, I don't collect any donations or subscriptions from you guys. But instead, what you can do is quite simple. If someone in your life wants to learn more about personal finance, investing, financial planning, send them this podcast or send them the blog, send them a blog post. Or better yet, albeit a little hypocritical of me, please share my work to your network, whether it's social media, Facebook, Reddit, LinkedIn, whatever. Hypocritical because I don't really spend much time on Facebook myself or anything like that. I try not to at least. But if you're willing, if you're so inclined, that's wonderful. Or another big source of 2024's growth here on the podcast was my appearances on other financial podcasts, Stacking Benjamins, How to Money, Choose FI, Catching Up to FI, a bunch of other podcasts. So if you listen to other podcasts where you think, geez, Jesse would be a great resource for that audience, I'd love it if you let me know about that or if you recommend me to that podcast host. What will next year bring here for the podcast? Well, for starters, some more of the same. I think a lot of the episodes are going to be, similar. I'll do some chit-chatting. I'll do some monologuing. I'll explain some thoughts to you guys. We'll bring on some expert guests to go deep on some things that I'm less familiar with. I will say, though, I get a solid amount of feedback saying, in short, hey, the more you talk, Jesse, the better I tend to like the episode. It's very flattering. Thank you very much. I do appreciate it. And so I might sprinkle in a few more solo episodes. We'll definitely do more Ask Me Anything episodes. I think those are some of the best received episodes out there. Or at the very least, I do want to make sure that the outside guests who I bring in, I want to make sure they can really bring the firepower because I want to make sure that listening to this is worthwhile for you guys. And hopefully the 41,000 and counting downloads that we have so far this year will continue to grow. And I do also want to address one of the other goals of the podcast, and that is the symbiosis with my professional life, working here at a fiduciary fee-only financial planning firm in Rochester, New York. In 2024 so far, about 25 listeners have reached out to inquire about working with me. And for probably 20 of those people, 20 of those families, they just wanted a simple review, a couple hours of my time. They're DIY planners. They don't want any sort of ongoing relationship with me. They just want to pay me hourly or pay a planner hourly, really just do a simple review, and that's about it. Now, I don't do the hourly model. I do ongoing work for an annual fee with people who want an ongoing relationship with their financial planner. Ideally, they want that for years, if not decades to come. Generally, I work with people who understand, a financial plan isn't a static one-time thing, but instead it's a dynamic plan, and therefore it's more than just a one-time engagement. I generally work with people who either don't want to be DIYers anymore, there's just too much for them to lose, or perhaps they never really wanted to be a DIYer in the first place, they just kind of stumbled into it. I work with people who they want a third party to be involved on behalf of their spouse. That's a very common one. One spouse I work with will be a pretty diehard DIYer, but for the sake of their potentially surviving spouse, if something were to happen to them, they want to bring me into the relationship as far as the finances go. I work for people who no longer want to drive their own bus, but instead want to focus on many of the other aspects of their life, of their limited time left on this earth. And so they'd rather outsource their financial plan, their investment management to me. Of course, I get that many people listening here, probably most people listening here, are DIYers, and I think that's wonderful. I'd be happy to refer you, if you do want a planner to help check your work, I'd be happy to refer you to one of many hourly planners who I know, who I trust, who do great work for their clients. But ultimately, yes, this year, many of the people who approached me, they weren't a good fit. I was able to refer them to someone who is a much better fit for me. But 5 families this year who came through the Best Interest podcast, they did reach out to me. And we started an ongoing financial planning engagement together. What's interesting, I think, is that 3 of those families, they're dedicated listeners, whereas the other 2 were referrals from listeners. In other words, a listener said to themselves, thanks, but no thanks, Jesse. I don't need you personally, but this person in my life who I know, they don't listen to your podcast, but they do need your help, and I trust you to help them. So to me, that's a huge win-win. They're getting the help they need. It inspires me to keep putting this podcast out into the world. Helping people is my job. It puts food on my table. And it proves out the business model, if you will, of the Best Interest podcast. Share knowledge for free, prove your expertise, make it so valuable that people can't help but share it. The audience will naturally grow. As the audience grows, some percentage, even a small percentage of people might say, you know what, I need some professional help. I trust Jesse at this point. He seems to know his stuff. The snowball grows. So thank you for listening. Thank you for your questions. Thank you for sharing this podcast with others and helping it grow. Thanks for reaching out to ask for help, for reaching out to refer others who are seeking help. One of my go-to sayings here is that a rising tide lifts all ships, and I believe that the Best Interest is one of those rising tides that is helping everybody involved. And now I want to present such a cool, a very meaty investing financial planning topic to you today. My hope is that I'm able to do enough of a complete discussion on this topic today that it's going to act as an evergreen monologue that we'll always be able to point back to and say, oh, you've got questions about this topic? Well, you should go listen to episode 96 of the Best Interest podcast. And that topic is this question: is now the right time to invest in the stock market? As I said, I'm recording this. You might be listening to this in December of 2024. Hopefully, many of you are listening to this well after December of 2024. And heck, for all I know, the market might crash next week. But whether the market continues its relentless climb or whether it crashes tomorrow, what I'm about to say here will still apply. In other words, the advice that I'm giving here is, if I may say so, timeless, right? It's going to apply. It's just sound investing principles that apply in a bull market, in a bear market, and everything in between. If you're a DIYer, you'll probably know the struggle and the complexity with this question: is now the right time to invest in the stock market? You might have some of the answers, such as, well, you can't time the market, or just lump sum your money as soon as possible. Or you might know that picking stocks is hard. And yes, all of those statements are absolutely true. But what I want to do today is explain, and ideally explain really well, why all those things are true and how all those ideas fit together into one cohesive investing framework. Because in my experience, if you don't understand why the truth is the truth in financial planning or investing, if you don't understand the why, and if you don't understand how those truthful facts all fit together like a puzzle, then you might be setting yourself up for a slippery situation. When the world starts to cast doubt on the truth as you understand it, you'll be more likely to abandon your beliefs, or put more directly, you can say things like, don't time the market or diversify your investments. But when the market keeps on hitting all-time highs, it can cast doubt onto that. Are you sure? You want to stay invested right now despite the crazy all-time highs? Or when Nvidia keeps on compounding higher and higher, are you sure you want to diversify your assets away from Nvidia? When US stocks compound higher and higher, are you sure you want to own international markets? When stocks in general are just crushing bonds like they have been, are you sure you want to own bonds? Understanding the why and the how behind these types of questions will make you what I believe is an invulnerable investor. That is an investor who will not succumb to fear, who will not let short-term concerns overwhelm them, who will not make short-sighted decisions that end up causing a long-term impairment of their capital. With that preamble, I want to start with Lynn, and I want to thank Lynn. Lynn is a dedicated listener and a reader. Lynn inspired me today, and Lynn is one of my muses here in 2024, inspiring articles about Social Security and the stock market, and now inspiring this monologue today. Back in August, Lynn wrote to me and she said, I'd like to move some of my money market funds into an S&P 500 ETF, but I'm waiting for the market to drop. I don't want to buy in at the all-time high, especially because I'm earning so much in my money market fund. I wrote back to Lynn. This is back in August. I sent her some articles and just some thoughts in general. And I explained to her, hey, Lynn, in short, it might be correct for you to wait right now, but historical probabilities dictate it's probably not correct for you to wait. And even getting the timing correct, the gains that you're likely to make are going to be probably pretty small. And since that email, well, sure enough, the S&P is up 8%, not including dividends. And Lynn wrote to me again last week, and she said, Jesse, it seems like you were right with this market and I should have invested. I'm personally against moving anything into the market right now, though. The financial independence community, it's all about being frugal, and buying into this super high stock market feels like it's not frugal at all for me. How do you square that? So that sets the table for what follows here, listeners. In the remainder of this episode, I want to explain two massively important topics to you. The first one is I want to explain why we invest in diversified indexes like the S&P 500 in the first place, and why we try not to invest in individual stocks. We'll take a sidebar on the idea of beating the market and another sidebar into something called the efficient market hypothesis. Maybe these are terms that are familiar to you, but I want to go deep on them today and explain them well so that you can walk away going, okay, now I really get it. And then second, I want to explain the concepts around timing the market. The explanation will include these little sidebar mini explanations of terms like lump sum investing and dollar cost averaging and the CAPE ratio. So first, why do we invest in diversified indexes like the S&P 500 in the first place? And why do we not try to invest in individual stocks? So one of the first lessons in long-term investing involves the challenge of picking single stocks. We're told to avoid searching for the needle in the haystack and instead just buy the whole haystack. That's a John Bogle aphorism, because it's amazing just how rare the needles are. There's a study by Arizona State professor Henrik Bessembinder, and it perfectly illustrates the rarity of the needles being, winning stocks. And we'll cover some of the highlights of that study today. Now, we recently discussed on The Best Interest this idea of a risk-free rate. Short-term U.S. Treasury notes provide that risk-free rate, which is why T-bonds, Treasury bonds, are frequently used as a benchmark against which other investments are measured. So in the study that I'm going to cite here, this professor, Henrik Bessembinder, he asked himself, how do individual stock returns compare against Treasury notes, the risk-free investment, the risk-free rate? And the answer is not well. Since 1926, 4 out of every 7 stocks, so over 50%, 4 out of every 7 stocks that have existed have underperformed Treasury notes. The majority of stocks lose to the risk-free rate, despite stocks having significantly more risk than bonds. So that's not a good thing, right? If we're taking on more risk in stocks, we sure hope to get better returns in bonds, and for most stocks, that's simply not the case. If you want to outperform the risk-free rate, picking individual stocks is a hard way to do so. So we know that 4 out of every 7 stocks, or about 57%, have historically underperformed the risk-free rate. And if we owned all those underperformers, our portfolio would look awful. So let's start adding in some winners and trying to get back to even, right? How many winners do we need to balance out all those losers, that 57% of losers? And the answer is, well, we need the next best 39% of stocks to get back to even. If we take the bottom 57%, which were all losers, and then we add in the next best 39% of the stock market, then we would get to a point where stocks, a diversified stock portfolio of those stocks, would have provided the same exact return as Treasury bonds, as the risk-free rate. So that's 96% of the total market. okay? That's the bottom 57% plus the next 39%, giving you 96% of the total stock market for the past 100 years, and you only would have received the same return as someone holding zero risk treasuries. So despite those sobering stats though, we all know, we've talked about it here many, many times, that stocks in general, the full stock market, well, it's crushed bonds over the long run. So far in this little part of the monologue, we're certainly not seeing it though, are we? Well, it turns out that the remaining stocks, okay, the top 4% of all stocks account for all of the stock outperformance in the past 100 years as compared to treasury notes. If you didn't own that 4% sliver, if that wasn't part of your portfolio, you missed out on all of the magic of the stock market. That 4% sliver, that's the needle in the haystack. The other 96% is just the hay, most of which is actually rotting hay. If only it was easy to identify those 4% of stocks that are needles, or at least maybe the 39% of stocks that are better than the risk-free rate. But it's not easy. It's quite hard, in fact, and we'll get into some of this later. Academic studies of mutual fund performance, again, these are professional stock pickers, those studies show that only about 1/3 of fund performance shows repeatability or skill. The rest of fund performance tends to be just luck. Most professionals, in other words, don't necessarily discover their needles. It's more like they stumble upon their needles. And stumbling upon a 4% needle, a 1 in 25 stock, that's improbable in and of itself. The only way, as far as I'm concerned, to reliably stuff your portfolio full of the valuable needles is to buy the entire haystack. You don't necessarily need to find the needles, and you certainly don't hope that you accidentally stumble upon them. Instead, you need to guarantee to yourself that you own all of the needles, and that's by buying a small sliver of every single stock out there. And yes, buying that whole haystack does mean you'll also be buying the bottom 96% of stocks too, with returns only as good as the risk-free rate. But you're certain to capture the sought-after 4% of stocks as well, providing all of the outperformance of the stock market. And you might ask yourself, like, really, is it that hard to find the needles? Well, commenting on Bessenbider's study, Jason Zweig of the Wall Street Journal wrote, traditional advice on diversification says you should own at least 15 to 30 stocks in order to reduce your risk. But in a sequel to his research paper, Professor Bessenbinder found that a portfolio of 25 stocks still has a 64% chance of underperforming the total market. Super stocks, the needles, are so scarce that you need to hold hundreds, even thousands of companies to be near certain of matching the market's return. In other words, listeners, small portfolios, they miss too many needles. The odds are stacked against you. You need to own hundreds or thousands of stocks to ensure you own those needles. But by the time you own hundreds or thousands of stocks, you're essentially building your own index fund. So why bother going through the time and effort to do so when you can simply buy an index fund with a single click? That, in short, is the argument behind index investing, especially in more efficient markets like the US stock market. The stock market has very few needles, and missing out on them negates the purpose of stock investing in the first place. Your best bet, literally, is buying the whole haystack. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. I want to read you from an article about this phrase, beating the market. The whole haystack, that's the market. And many of us have heard before that you can't beat the market. So I want to dive into that statement because on its face, and to be fair, it's a wrong statement. But again, understanding why and how it's wrong and understanding the better ways to phrase that statement is going to help each of you listening to be better long-term investors. You cannot beat the market. We hear this warning all the time. Let's say it's the S&P 500 index or the Dow index or the NASDAQ or a total stock market index fund or something similar to that. These people who say you can't beat the market, what they're saying is you cannot outperform a diversified pool of stocks. But if we peel back the onion on that guidance, we face 2 logical issues. The first is there's an averaging problem. The market's return is an average of many different stocks. You can't have every individual stock losing to an average of those stocks. The logic of that just doesn't work. Second, if my stock picking strategy loses to the market, as people might suggest, then my anti-strategy should beat the market. If one person is losing, well, Well, just do the opposite of them. If they're going long on certain stocks, just go short on certain stocks, those same stocks, and voila, if I lose, you'll win. Thus, at least one of us has beaten the market. So that was a quick little logical aside that shows that clearly it's not true to say you can't beat the market. It's an incomplete statement. It needs more details, it needs more backup, and it leaves people a little bit misinformed. It's one thing I want to fix today. So yes, you can beat the market, but you need to understand how and when and why. And answering those kind of questions today will lead us to the following conclusion. The question isn't whether you can beat the market or not. You can. The question is, why bother trying? See, thousands of people beat the market every day, every month, every year. Some investors have beaten the market for decades. It doesn't take prodigious intelligence. It only takes the right temperament. So anyone who says you can't beat the market, they're misinformed. But the first truth is it's quite hard. Consistently beating the market is hard. That's what the needle in the haystack has to do with, right? You need to find those 4% stocks, or at the very least, you need to ensure that you're in that 39% part of the stock market that beats the risk-free rate. And you need to really maximize your time spent there. Now, consistently beating the market, though, after any fees you pay, well, that makes it extra hard. If fees aren't involved, it's possible to beat the market. Not easy, but certainly possible. When someone else is managing money for you, if they charge you a fee, well, that fee eats into your profits. And since those profits have been eaten, well, beating the market becomes even harder. It's like in golf. If you begin your round with a few strokes already on your scorecard, it's still possible to shoot under par, but much, much harder. Now, truth number 2 about beating the market is it's not 50-50. And what I mean is you might think at this point, so without fees, 50% of stock pickers would beat the market and 50% of stock pickers would lose to the market. That is a logical conclusion, assuming, though, that stocks' performances follow a normal distribution or a bell curve. Human height, as an example, forms a nice natural bell curve. You get a standard distribution with an average, most people relatively close to the average, and far fewer people who are multiple standard deviations away from that average. But stock performances do not follow a normal distribution. This is an interesting, exciting, and an important fact. Instead, stock performance more closely follows a long tail distribution. Most individual stocks perform worse than the average, but a small number of high performers beat the average. To explain what I mean by that, imagine I have 10 stocks in front of me. 9 of those 10 stocks are worth $100. The 10th stock, though, it's worth $1,100. So I have 9 stocks at 100. I have 1 stock at 1,100. What's the average value of these stocks? Well, if you followed my math, the average value of those stocks, the total value is 2,000, and I have 10 of them, so the average value is 200. 9 of those 10 are only worth 100. 9 of those 10 are underperforming my average. The one that's worth $1,100, well, it's outperforming my average. So if I'm going to build a portfolio from those 10 stocks and I hope to quote unquote beat the market, I really have to hope I have some ownership of the one that's outperforming the average. That, in a nutshell, is the way that the stock market works and always has worked. There's some interesting data. I cite some data in this particular article from 1983 to 2006, tracking 8,000 individual stocks over that time. It showed that about 40% of stocks lost money over that time. Yikes. 64% of stocks, though, underperformed the average. Okay, 64% underperformed the index, got beat by the market. The remaining 36% of stocks outperformed the market. So it wasn't quite like my example of having 9 underperformers at $100 per stock against 1 outperformer at $1,100 per stock, but the same idea applies. You have 64% of stocks that do pretty poorly. You have 36% of stocks that do so well that they bring the average up. A couple other interesting stats from that particular study, for what it's worth, is that the mean average annual stock return over that period was negative 1.06% per year, and that the bottom 75% of stocks had a cumulative total return of 0%. In this particular study, all of the positive performance from the stock market in, I think it was a 27, 24-year period, came from the top 25% of stocks. Okay, so what does this have to do with beating the market? Well, the research tells us that beating the market is not a 50-50 proposition. Over this particular time period, a single stock only had a 36% chance of beating the market. There are many bad to mediocre stocks. There are far fewer good to great stocks. So again, if you're only picking a few stocks, you're likely to miss out on the big winners and you're going to lose to the market. If you're picking many stocks, well, then you're simply going to mimic the average return, neither beating nor losing to the market. You've just created your own index fund. And that's why it's hard to beat the market. There's also a luck versus skill problem in picking stocks. The stock market, as we've already covered here, it's a mixture of luck and skill. It's notoriously difficult, though, to discern between those two, skill being a repeatable thing, luck being the opposite, something that's not repeatable. If you invest via active stock picking, you'll face some scary questions, like, have you recently beaten the market? If not, why are you investing in that way? Assuming you have beaten the market, is that skill or are you just lucky? And then last, do you really have the knowledge and the skill to accurately assess those other two questions? It's a pretty convoluted spaghetti logical mess in your head. Now, the stock market is a notoriously efficient market, and we should talk about what that means. It means that there are so many different investors who are armed with so much information about various companies, their stocks, their earnings, their futures, that any single person cannot consistently know enough to know whether today's stock prices are right or wrong, whether the market is overvalued or undervalued, whether today's smarter decision would be to buy or sell. It's just too hard to know that consistently, to know more than the market consistently. That's what an efficient market means. And thus, the efficient market hypothesis essentially states there's no such thing as skilled stock picking, because that so-called skill would suggest that someone does know more about today's prices, whether they're right or wrong, or at least that some investor can outsmart the rest of the market with some sort of consistency. Now, the efficient market hypothesis has a lot of research behind it. It's won Nobel Prizes. It's part of the backbone of index investing. That said, it's not necessarily this iron law of nature, and there are many smart people out there who find some pretty serious flaws in it. Warren Buffett and Charlie Munger, perhaps most notably among them. Personally, I think that, at least here in the US stock markets, are mostly efficient, and that, at least for most of us, those of us listening, DIYers, simple investors, we would do better by believing that markets are efficient. In other words, you and I, we don't have the time, the resources, the knowledge, or in other words, the skill to consistently know more than the rest of the market. And any such skill is likely to be found in those who put in the most time. In other words, the 80-hour weeks of a Wall Street pro are likely to be more skilled than the 20 minutes that you spend watching my Uncle Jim Cramer on CNBC. Now, are you sure you want to play that game against those Wall Street experts? Wouldn't the average return from an index fund be simpler, easier, less stressful, and more dependable? To reiterate all this, saying nobody can beat the market is like saying nobody is taller than average. It's a little bit dumb. But you'll notice that my tone has kind of changed over these last few minutes. Because yes, you can beat the market. It's just a logical necessity, but it's also complicated. It happens less than 50% of the time. It's hard to repeat. Sometimes it's just luck. Your investing fees are probably going to reduce your likelihood of beating the market. That's just basic math. And even if you do beat the market, was it skillful? Was it just lucky? If you're a DIY investor, is the time that you commit to that active investing, is that worthwhile? And then last, are you smart and unbiased enough to even answer all these questions in the first place? These kind of complications all point in the same direction, namely, why bother trying to beat the market in the first place? It's not that you can't beat the market, it's just not worth trying. So one thing I haven't really touched on quite yet so far in this monologue is why picking stocks is such an interestingly hard exercise in the first place. It's fine and dandy to say, okay, most stocks underperform. It's fine and dandy to say only the 4% needles lead to all the outperformance over the risk-free rate. But why is it so hard to find those 4% needles? Surely there must be a way to do so. Because simply, who's to say whether a stock's price is too high or too low or fair? And for that, we need to understand how our stock price is reached in the first place. They're based on two simple things: how a company is performing, its earnings, and how much investors are willing to pay for those earnings. Sometimes that's called the multiple. The multiple can be thought of as how likely do I believe that this company's earnings will continue into the future. A simple example, let's say a grocery store is earning $1 million in profits last year. How much would you pay for that store? $3 million, $5 million, $10 million? Well, that's a 3 or a 5 or a 10x multiple. And that number is going to be related to how confident you feel that you could take over the store, keep its earnings at $1 million per year, or ideally even grow those earnings for enough years in the future so that you can get your money back and then some. A stock's price works exactly the same way. It's just a business, just like the grocery store is. But it's easy to forget that fact, and that leads me to a wonderful question I once got from a client here who had about 20% of her money in Starbucks. Now, 20% of your money in one company, that's a lot. You could say it's a latte in one stock. I'll see myself out after that joke. And for comparison, Starbucks comprises about 0.20% of the S&P 500. Now, the S&P 500 should only be a portion of an individual stock holdings, which are only a portion of an overall portfolio. So to have 20% of your total assets in one stock, that's just way too much. When I started explaining that thought process, the client understandably protested. She said, "Jesse, there's a Starbucks on every corner in America. Why would we sell it?" That logic, totally understandable. After all, she's right. There is a Starbucks on just about every corner in America. The premise is true, but the client's conclusion, therefore, why sell Starbucks, that doesn't follow the premise. And that's the logical misstep I'll dive into. A good company doesn't always make a good investment. Now, my hometown pride, Kodak, was once one of the most visible companies in the world. It would have been easy to sit there in 1985 and think, man, Kodak is everywhere. They own the global film market the same way that GE owns consumer electronics and Sears owns department stores. Why would I ever diversify out of Kodak? Well, the share price went from $90 per share to zero in about 17 years. The stock market and economic history are littered with good companies going broke. It's called creative destruction, and it's an essential part of a healthy economy. But it's terrible if you happen to own those specific stocks. Now, investor Peter Lynch is known for many quips, but perhaps none is more famous than his saying, "Invest in what you know what you own, and know why you own it." Unfortunately, many investors interpret that quote as invest in what you've heard of and own it because you've heard of it. And what they've heard of, naturally, are popular consumer brands and companies with a high frequency in society. Those with many stores, with many products, with long histories. But what Lynch actually meant in his quote was, the more familiar you are with a company, the better you'll understand its business and its competitive environment. The better chances you'll have of finding a good story that will actually come true. You can't just know Starbucks because you enjoy a latte or because you see it on every corner. You must know its business fundamentals, its competitors, its potential future pathways. The market doesn't care about popularity or frequency of its stores. It only cares about popularity and frequency insofar as those factors positively or negatively affect the objective financial fundamentals of the business. Riffing on that previous stanza, concepts like popularity and frequency, they're both hallmarks of a company's past, right? The stores you see, the brands standing in our culture, the company's heretofore investment returns are all a function of what the company has done in the past. But the stock market is forward-looking. The thousands of investors who buy and sell stocks and determine their daily prices, they don't care about the past. They are quite literally trying to predict a company's future. They are pricing in that anticipated future into today's fair value. Quite understandably, most investors, or at least many investors, don't understand that. They don't do that. They either shape their opinions based on the past, popularity, frequency, past investment returns, or they react to current day news. And those are both mistakes. The intelligent investor thinks about the future, but any statement akin to, well, company ABC will be great in the future, that's a pretty challenging statement to make accurately. Nothing against Peter Lynch, but most of you know I'm a pretty big fan of Uncle Warren Buffett, who is famous for saying, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Even if Starbucks is one of Buffett's wonderful companies, is it trading at a fair price? Most people, including many investment professionals, are terrible at determining what a fair price truly is. And price is a defining feature of any investment. I frequently use the Honda Civic example to explain that idea. Is a Honda Civic a fair car? Sure. Is it a good to great car? Maybe. Would you be happy owning a new Honda Civic? Many of you would say, yeah, sure, I'd own a Honda Civic. But would you pay $100,000 for a new Honda Civic? No way. It's not enough to say Starbucks is a good company, perhaps a great company. That's a challenging enough statement on its own. We must go further and ask ourselves, is Starbucks trading for a fair price? And quite simply, most of us are terrible at determining what a fair price truly means, at least when it comes to stocks. And play along with me. Let's assume for the sake of argument that my client was correct. Because Starbucks is everywhere, it must be a good stock to own, and it's trading at a good price. If that's true, does it necessitate that Starbucks should still comprise 20% of their portfolio? Or put another way, is Starbucks one of the top 5 companies in America, right? 100% divided by 5 is 20%. Are there only 5 good companies in America? Right? I bet you could rattle off 10 equally recognizable publicly traded companies in the next 30 seconds. Try it. They're everywhere. Any way you cut the cake or the biscotti, a 20% position in one company is severely overweight. In financial planning, we want to reduce our range of potential outcomes. That's why we diversify in the first place. Having 20% of your money tied to one single stock leads to a wide range of potential outcomes. For what it's worth, that client did listen to our counsel and has been divesting out of Starbucks, at least as tax efficiently as possible. And that, listeners, concludes the first part of today's idea, the idea of why we invest in diversified indexes like, say, the S&P 500 in the first place, and why we try not to invest in individual stocks. Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. Now for the second part of today's idea, I want to explain the concepts around timing the market. This explanation will include little sidebars like lump sum investing, dollar cost averaging, the PE ratio or the CAPE ratio. So going back to Lynn's original question, it makes so much sense, right? With the market at all-time highs right now, like it is here on December 12th of 2024, why is right now a good time to invest, right? Surely we should be buying low and selling high, but you want me to buy high? You want me to buy at an all-time high? Okay. First, I want to explain the CAPE ratio. CAPE, cyclically adjusted price to earnings. It's very much related to the price to earnings ratio, which I think we touched on before. It's a way of measuring what stocks are selling for, their price, against how well those companies are doing financially, their earnings. And the CAPE ratio is smoothed out over time to account for inflation. That's the cyclically adjusted part of it, CAPE, cyclically adjusted price to earnings ratio. Now, logically speaking, Lynn has a pretty good point here. We know that the S&P 500 price is at an all-time high. And we know that price is one of the great equalizers in determining if an investment is good or not, right? Our Honda Civic example or the hamburger example. Are burgers good? Yeah, hamburgers are good. Would I pay $100 for a hamburger? No, I wouldn't. Price matters, okay? Quality is one thing, but price is important too. Historically, the S&P 500 CAPE ratio oscillates between 10 and 25. And generally, though not always, the lower the PE, the better the forward-looking investment opportunity. That makes intuitive sense, or at least I think it should. The lower the price that I'm purchasing my investment, the better my long-term returns will be. But does that mean that we should avoid investing in any sort of stock market altogether simply because the PE, the price to earnings, or the CAPE ratio is high? The answer there is no, not really. Just because the CAPE ratio is high, it still might be smart to invest. And we're going to link something in the show notes, an article I wrote called Timing the Future Market, CAPE versus Future Returns. And in that article, you'll see some pretty interesting graphs that I put together where we could point to plenty of times where the CAPE ratio was 25 or 30, very much on the high end, and the future inflation-adjusted 10-year returns or 20 or 30-year returns were a perfectly normal and acceptable 5, 6, 7, 8%. Just because the CAPE ratio is high, there is no golden rule stating that you must avoid investing. For reference, right now, as of this recording, the CAPE ratio is at 38, which is very, very high by historical standards. And again, going back to Lynn's point, if I'm paying a very, very high price for the stock market compared to historical standards, surely that can't be a good thing. Surely I must be spending $100,000 on a Honda Civic right now. Well, I hear you, Lynn. Now, the CAPE ratio hasn't been below 25 since the year 2014. And that has some people seriously concerned. Are we in this massive 10-year bubble of high valuations? And at some point, is that bubble going to pop? Maybe. I might not know enough to have an answer to that question. But I do know the counter argument here. I think it makes a lot of sense, and I'm going to try to lay it out simply. 100 years ago, the American economy was pretty hands-on. Manufacturing, production, factories, buildings, stuff that is expensive to make and expensive to scale. Meaning, if let's say Ford wanted to double its car creation capacity, it had to buy new land and build new factories and train new people and put in new assembly lines. And all of that is really expensive for a company to do. And it ultimately eats into that company's earnings and growth. In other words, it was really hard for those kind of companies to rapidly expand their profit margins. But today, many of our biggest companies work much differently than that. If Microsoft wants to sell 20% more Office licenses, they don't need any additional capital overhead to do so. They just sell more licenses. Many companies in today's digital age, they work the same or at least very similar ways to Microsoft, right? They don't have these massive capital requirements to grow. like the ones that existed 30 or 50 or 100 years ago. And as such, those companies can grow their earnings much faster than historical standards. And if that's true, maybe I am perfectly okay to pay a 38 times CAPE ratio today, because I believe the earnings portion of that equation is likely to rapidly increase in the coming years, turning today's price into quite the bargain. The point being that while the CAPE ratio or the PE ratio is generally helpful, it's not necessarily smart to believe that the PE ratios of the 1950s ought to instruct how we invest today. And then going back to the main point of today, just because a PE ratio is high, we can still have strong long-term future returns going forward. It's hard to time the stock market based on PE ratio alone. Instead, there are a couple simple, tried and true techniques when it comes to investing your money into the stock market. Probably some things that you might have heard of before. To start, I want to tell you a story from 2022, which was in the middle of a bad year for both stocks and bonds. And those kind of bear markets, they make you question, should I just wait for the bottom before I invest? And reader of the blog, Paulson, he wrote in during that year and he said, Jesse, I'm not tempted to sell anything in my 401k or Roth IRA, but I don't know why I should continue buying, at least not at this point with the market doing what it's doing. It's not going up anytime soon. Can I contribute money to those accounts as cash and then wait to invest once the market hits its bottom? It was a great question. And yeah, you could try, Paulson. That's what I responded to him, but I don't think he should. And there are a few reasons why, and these reasons apply to you listening today. Because timing the market in the way that Paulson suggested, first, it barely affects your future portfolio. Second, it's really hard to execute well. And third, it makes your life demonstrably worse along the way. So here's a story of 3 hypothetical fictional investors. Mostly, they're identical investors. We've got normal Nick, we've got good timing Gary, we have bad timing Bill. Normal Nick, good timing Gary, bad timing Bill. All 3 investors started their investing in 1985 when they were 22 years old. They're now 59 and they're approaching retirement. And some other facts about them. All 3 of them use the S&P 500 index funds for their stock investments. All 3 invested $200 a month in 1985 and then increased their contributions by 5% per year until today. So now they invest around $1,200 a month. And all 3 invest via dollar cost averaging. We'll dive into that term in a couple minutes. The point being is they invest whether the markets are high, they invest whether the markets are low, and they buy in between as well. Except for one time. Now, during the great financial crisis that threw a small wrench into their plans, Nick, normal Nick, well, he stayed the course and continued his monthly contributions. But Bill and Gary, they wanted to try something different. Good timing Gary, with his good timing, he managed to time the market perfectly. He stopped investing, just like Paulson wants to with the question that inspired this article. Gary stopped investing at the market top in 2007. He saved all his cash. He then perfectly timed the market bottom in March of 2009, deploying all of his cash into the stock market. So he timed the market to perfection twice. He stopped investing at the perfect top, and then he began investing again at the perfect bottom. Bad timing Bill also timed the market top with Gary, but when the true bottom hit in March 2009, Bill was convinced that there was more room to drop. So as the market recovered, Bill waited and waited and waited. He thought a new bottom would eventually come. So he didn't deploy his cash until 2013 when the market price had fully recovered to 2007 levels and his wise wife screamed at him to get back into the market. Now, fast forward, I wrote this article in 2022. How different were Nick's and Gary's and Bill's portfolio at that point? Well, Gary was best. After all, he timed the market perfectly twice and he had $1.46 million. Bill was worst. After all, he missed many buying opportunities for about 5 years. But he had $1.38 million, and then Nick was right in the middle at $1.42 million. So again, Gary with the best perfect timing, 1.46, Bill with the worst, 1.38, and Nick in the middle at 1.42. The perfect market timing around 2008, which was a huge crisis, right? That got Gary a 3% edge over normal Nick. And Bill messed up big time, yet Gary only has a 6% edge over him. In the long run, Gary's perfect market timing wasn't actually that important. Now, notably though, Bill and Gary, when they chose to time the market, they didn't sell any of their old investments. All they did was choose not to buy new investments. If they had sold their old investments though, and then rebought later, our conclusion would be much different. Bill would have lost another 20% of his total portfolio as of today, despite perfectly timing the market top. Okay, he sold at the perfect time. But because he didn't buy back in until it was 3 or 4 years too late, his portfolio would be down about 20% today. And Gary, who was perfect twice at the top, at the bottom, his portfolio would be about 50% higher today. So it just goes to show, if you're only perfect once with market timing, you could be down 20% like bad timing Bill. You have to be perfect twice like Gary to actually be up a large amount. And that begs a question, do you feel that lucky? Personally, I like where normal Nick is at. He didn't worry at all about timing the market, zero skill, zero luck, and also zero stress. He just kept on buying, and he's in a great place. This is a scenario where the juice simply isn't worth the squeeze. The squeeze, again, is double perfection. You have to be right twice. If you manage to be right the first time, ceasing your buys before the market bottom, you'll likely be plagued by bad timing Bill's issue. When the market is at peak pessimism, right? When the market is truly at the bottom, that's peak pessimism. Do you have the skill and the knowledge and the balls of steel to deploy your money into that market? Or are you a dumb would-be market timer like the rest of us are? And then what's the juice you get for that squeeze? Well, it's a 3% boost on your final portfolio. Or maybe this time will be different. Maybe you'll get a 5 or a 6 or a 7% boost on your final portfolio. And while your money is out of the market, sitting on the sidelines, what will you be thinking? Are you just going to be chilled out and relaxed with ice in your veins? Or are you going to be a nervous wreck, worried about when to get back into the market? Not only can this squeeze cost you money, but its psychological cost is unavoidable. Gary, sure, he gained 3%, but he also gained some white hair. He was out of the market for 18 months. 18 months is a really long time. Are you willing to wait 6, 12, 18, 24 months or more for a bear market to end? Now, personally, I'm not trying to time the market over that period of time. I don't want to sit on my thumbs and hope that I time it perfectly. Who knows how long it'll take for us to return to all-time highs when the next bear market hits. I don't want to test my skill with timing the market. I don't want to test my blood pressure by staying out of the market. So that story introduces an idea, dollar cost averaging. Many of us are doing it without even realizing it. That term, interestingly, it kind of has two definitions, though they're somewhat related. The first definition of dollar cost averaging is to make a series of investing contributions on regular intervals, such as the way that many of us might contribute to our 401k accounts. Every 2 weeks, $500 comes out of my paycheck into my 401k, and it's invested into a target date fund. That's dollar cost averaging. Now, the second definition, though, it involves starting with a large sum of money and then making the decision to deploy that money into an investment over a specific period of time. Now, that, in my opinion, is a great idea for Lynn to consider today. Rather than dumping 100% of her new investable money into the S&P 500 today, perhaps she decides to contribute 10% of that money every single month for the next 10 months. That way, if the market does tank in February or whatever, some of her money will benefit from that future price drop. Now, both of those definitions of dollar cost averaging share in common the idea that you're buying assets regardless of price, that you're willing to accept that sometimes you might buy high, other times you might buy low, and in the long run, it's all going to average out. Either way, you are not timing the market. That all said, we should cover an interesting piece of math and a term called lump sum investing. In short, if we look back on market history, would we be better off taking that Lynn approach of 10 deposits over 10 months? Or should we invest it all at once as soon as possible? Looking back in history, about 3/4 of the time, you would have wished you made the lump sum investment upfront. That should make sense, I think, because if we look at market history, we can easily see that it has a terrific habit of going up over time. As such, any sort of waiting to invest that we do, well, historically, it's worked against us. The market goes up, and if we're waiting, it's going up away from us. In general, if I knew that regret was not a human emotion, I would always recommend that people invest their money in a lump sum as soon as possible. But regret is a human emotion, and we must be aware of that fact, and it feels pretty bad to lump sum your investment today only for the market to go down next week. Therefore, if you're worried about investing everything at once, then dollar cost averaging can be your friend, allowing you to slowly but surely get your money into the market over time. Depending on your level of hesitancy, you could dollar cost average for months or even years. So that's how and why we should continue investing even during frothy markets like this one. Because we don't know whether it's a bubble that's about to pop or simply another stair higher on a long staircase that could go on for years or decades into the future. Here's a fun fact though. Lynn's thoughts right now, understandably, is the market is so high. Surely it's not a good time to invest. But I also got messages like one from Christina in March of 22, where the major part of Christina's message was the market is down. Should I continue investing? Humans are natural worriers, and it's funny that whether the market is up or down, people will worry about whether continuing to invest is smart behavior. But if we look at the historical track record, we see that continuing to plod forward in our investments is a smart thing to do. And the list goes on as far as reasons why not to time the market. For example, in general, market performance comes in clusters. As of this recording, the S&P 500 is up 28% so far in 2024. About 20% of that 28% came from the best 4 months this year. The remaining 8 months account for the other 8% of the 28%. I could point to any year and that same pattern would exist. Market returns come in clumps. And the more I try to time the market, the harder and harder it gets to make sure that I'm capturing those infrequent clumps. For example, if I look at weeks instead of months, I see that 20 of this year's 28% comes from the best 7 weeks in the market. If I look at days instead of weeks, I see that 20% of this year's 28% return comes from the best 12 days in the market. The more you try to play around with the perfect time to buy or sell your investments, the more likely you'll be sitting on the sidelines for one of those 4 important months, or one of those 7 important weeks, or one of those 12 important days. And to be fair, because you might have heard a similar stat like that one before, but I've never seen anyone discuss this, that losses are also concentrated too. For example, the worst 12 days so far in 2024 are down a combined 22%. So avoiding those terrible days, that's a good thing too, right? It is. Except for the fact that we have more good days than bad days, and usually the good days are more consequential than the bad days, and missing out on those good days, it really, really hurts. If you don't time the market, you'll always be in the game during those good months, those good weeks, those good days. And yeah, there will be bad times too, but zooming out, that's an okay trade to take all the good days to outweigh the bad days. And this final point for you listening has a bit to do with the efficient market hypothesis again, but I want to re-emphasize. Markets are inherently complex and influenced by a wide range of factors that interact in unpredictable ways. These factors include economic data, indicators like GDP growth or unemployment rates or inflation or interest rates. Markets often react not just to the data itself, but whether that data aligns with or deviates from expectations. The market is a function of geopolitical events, political instability, elections, international conflicts, trade policies can all cause sudden and unpredictable market swings. Corporate earnings and news, right? Company-specific developments like an earnings report or a product launch or a management change can lead to a sharp movement in stock prices. Natural events, natural disasters, pandemics, breakthroughs in technology can ripple effects across industries and markets. Then you just have investor sentiment, Mr. Market, right? Human behavior plays a really significant role in market movements. Fear, greed, herd mentality can lead to irrational buying or selling, and that just amps up the volatility. Nowadays, with technology, you have market feedback loops, right? Reactions to an initial movement can trigger further buying or selling due to algorithms and margin calls, investor psychology, compounding volatility, and then you just have random noise. Daily market fluctuations result from minor random events, a rumor, a small trade that are just difficult to predict. It's a little bit of the butterfly effect, just not tied to any sort of fundamental change. Because those factors are interconnected and can influence each other in unexpected ways, accurately predicting short-term market movements is nearly impossible, even for experts, and that unpredictability underscores why attempting to time the market is risky and why a long-term disciplined approach often yields better results. Going back to Lynn's most recent statement, it seems like you were right, Jesse, with this market. I should have invested. I'm personally against moving anything into the market right now. The FI community is all about being frugal, and buying into the super high market feels like it's not frugal at all for me. How do you square that? Well, Lynn, I'm right for now. For all I know, the market could crash 20% in the first quarter of 2025, wiping out all of the gains since August and actually proving you right for waiting. But more often than not, as I've talked about here today, waiting like you've done won't have been a smart thing to do. And if you are proved right, let's say the market does crash next month, I'm worried it might teach the wrong lesson. And that lesson will be, when my gut tells me not to invest, I won't invest. And if there's anything I know about this world and the stock market, it's that there's always a negative reason in your gut to make you hesitate from investing. And looking back in time, those gut feelings would have led to a lot of lost compound interest. So if you've made it this far, I hope I've done a good job explaining why we invest in diversified indexes like the S&P 500 in the first place, and why we try to avoid investing in individual stocks. And second, I hope I've explained the concepts around timing the market, or not timing the market really, including dollar cost averaging, lump sum investing, the CAPE ratio, and those kind of things. If you ever have doubts in the future about whether now is a good time to invest, I hope you'll come back and give this a listen. And again, I want to thank you all for tuning in to the Best Interest Podcast, not only today, but throughout 2024, making it the best year of the podcast yet. This is so much fun for me. Thank you for all the kind reviews and ratings on Apple Podcasts and Spotify. Thank you for all the emails and questions. Please keep them coming. A very happy holidays to you, and here's to a terrific 2025.
Thanks for tuning in to this episode of the Best Interest Podcast. If you have a question for Jesse to answer on a future episode, send him an email at jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves, and we really appreciate it. We'll catch you on the next episode of the Best Interest Podcast. The Best Interest Podcast is a personal podcast meant for education and entertainment. It should not be taken as financial advice and is not prescriptive of your financial situation.